Building wealth isn't just about returns anymore. It's about values, about investing in the future you want to see, not just the profit you want to earn. Hello and welcome to FluxFolio Finance, where we believe your money should have meaning. Today, we're exploring the top 5 ESG investments for young investors in 2025. Options that don't force you to choose between impact and performance. More than ever, millennials and Gen Z are reshaping markets. Surveys show nearly 99% of Gen Z and 97% of millennials want to increase sustainable allocations this year. Over 80% believe ESG investing doesn't hurt returns, it enhances them. So what does ESG really mean? Environmental, social, and governance. It's a way of screening investments based on how they treat the planet, their people, and their governance practices. It's not charity, it's smart investing that recognizes risk and opportunity in a changing world. Let's look at 5 top ESG approaches for 2025. First, the broad-based anchor, iShares ESG-aware MSCI USA ETF. With over $20 billion in assets, it's a go-to for ESG-minded investors. It tracks U.S. large-cap stocks while screening out the worst ESG offenders. Think of it like a sturdy oak in your portfolio, deeply rooted, dependable, but greener at the top. It's ideal for those who want low fees, strong diversification, and simple ESG alignment without sacrificing exposure to the core U.S. market. Second, sustainable bonds. These aren't stock. They're fixed-income products funding real-world impact, green energy projects, affordable housing, climate resilience. The sustainable bond market is booming, with trillions in assets. They offer stability and purpose, steady income, plus measurable impact. Imagine your bond interest funding solar farms or social housing projects instead of oil rigs or speculation. Third, Thematic ESG funds. This is where values get specific. Want to focus on renewable energy, clean water, gender equality? Thematic ESG funds let you target the changes you care about. In 2025, digital ESG strategies have taken off. AI-powered platforms and blockchain-based tracking are making transparency better than ever. Investors can see precisely where their money goes. It's not vague green branding, it's measurable progress. Fourth, emerging market ESG funds. Developing economies face enormous sustainability challenges and opportunities. ESG-screened emerging market funds let you support responsible growth while accessing higher potential returns. Big data has improved transparency in these markets. Companies face stronger governance pressure. Risks are better understood. Think of these funds as planting seeds in fertile but underdeveloped soil, investing in growth that's sustainable, not exploitative. Fifth, ESG integrated technology. This is the cutting edge. AI-driven ESG tools can screen supply chains, flag companies overusing plastics, highlight labor violations, and track carbon footprints in real time. They're turning ESG from a marketing buzzword into a granular, data-backed discipline. For investors, these platforms help build portfolios aligned with your values while managing risk. It's not about trusting a label. It's about knowing your money's real-world impact. Why is this moment so important? Because demand is surging, but the market is messy. Europe is doubling down on ESG regulations. The US has seen backlash and greenwashing scandals. Some firms slap ESG labels on funds still full of fossil fuel giants. Others drop the label altogether in greenwashing to avoid scrutiny. But the underlying demand remains. Nearly 90% of young investors plan to maintain or increase ESG allocations this year. That's a tidal wave of capital moving in one direction, even if the surface is choppy. It's no longer about whether ESG matters. It's about doing it right. A smart ESG portfolio for young investors in 2025 might look like this. 1. Anchor a broad ESG ETF like iShares ESG Aware MSCI USA. 2. Stability, sustainable bonds for steady, mission-driven returns. 3. Precision, thematic funds aligned to your personal values. 4. Growth, emerging market ESG exposure for diversification. 5. Oversight, ESG integrated tech to avoid greenwashing. It's about aligning your money with your future, not just your present. Because investing is always personal. It's your savings, your goals, your ethics. But in a world facing climate change, inequality and governance failures, personal choices ripple out. And those ripples can become waves. ESG investing isn't just about categories and acronyms. It's about real lives, real money, and real impact. Let's talk about how this looks on the ground. Meet Lana. She's 28, a teacher with a modest income. She starts with a broad-based ESG ETF like iShares MSCI USA. It's her portfolio anchor, simple, diversified, aligned with her values. As she grows more confident, she adds green bonds to fund solar schools in her city. Her investments aren't just abstract numbers. They're helping light classrooms. Then there's Jay, 24, working at a fintech startup. He uses an AI-powered ESG screening app to double-check his portfolio. He finds out one of his clean energy funds holds fossil fuel giants. He's shocked, and he divests. This is the reality of investing in 2025. Demand is booming, but greenwashing is everywhere. A 2025 investigation found European ESG-labeled funds held nearly $33.5 billion in fossil fuel companies like Shell and ExxonMobil. Germany's DWS even paid $25 million in fines for misleading ESG claims. It's a reminder that the label alone isn't enough. Douglas Flint at Aberdeen bluntly warned the city that pretending to save the world while investing in polluters is not just unethical, it's a legal risk. That's why young investors need to be vigilant. Greenwashing happens when marketing outpaces reality. Vague promises, selective data, and feel-good slogans can hide investments that contradict ESG goals. Here's how to avoid it. 1. Demand transparent reporting. Funds aligned with Europe's new CSRD rules have to disclose detailed, consistent ESG metrics. 2. Use tech tools. AI can scan supply chains, spot hidden emissions, and flag companies with labor violations. 3. Compare ratings. ESG scores aren't uniform. Cross-check multiple agencies and methodologies. 4. Watch for legal news. Big fines and regulatory probes are red flags. Investors need to ask, where does the money really go? Because every dollar is a vote for the future. Let's talk strategy. A robust ESG portfolio doesn't bet everything on one fund or theme. It layers impact like this. A broad ESG ETF for a stable core. Sustainable bonds to lock in income and fund real-world projects. Thematic funds to target personal passions like renewable energy or gender equity. Emerging market ESG exposure for growth and diversification. In ESG integrated tech to monitor and adjust holdings with transparency. This approach spreads risk while staying true to values. But there are challenges. The US is seeing a wave of greenwashing. Facing political backlash and new SEC rules, firms are dropping ESG labels even if their strategies remain sustainable. Europe is moving the other way, tightening ESG definitions and pushing for clear, standardized disclosures. This divergence means investors need to do more homework. Even the best-intentioned funds can end up exposed to unexpected risks if they don't scrutinize supply chains, labor practices, or board diversity. But this is also where opportunity lies. Nearly 90% of young investors plan to keep or increase ESG allocations. Demand is clear. That capital is searching for real impact, not marketing hype. For those willing to look deeper, ask hard questions, and use the best tools, ESG investing can deliver returns and progress. Because climate change, inequality, and governance failures aren't distant problems. They're here. They're market risks, and they're investment opportunities for those ready to lead. So as you plan your own ESG strategy, think about your values, your goals, your risk tolerance. Remember, 1. Anchor with a broad ESG core. 2. Reinforce with sustainable bonds. 3. Define your values through thematic funds. 4. Diversify globally with emerging markets. 5. Monitor actively with tech and data. Your money can reflect your ethics without sacrificing performance. It's not about charity. It's about building the world you want to live in and getting paid for it. Thank you for being part of FluxFolio Finance. If you found this helpful, subscribe and join us again as we explore the strategies, risks, and opportunities that shape your financial future. Until next time, invest with purpose, grow with confidence.